All right, for this video, I want to go through a sample Schedule K-1 for the 2024 tax year, and this is going to be from a Form 1065 partnership return. So we've got a sample K-1 package here for our partner, and then we've also got a sample Form 1040 for the same partner, so we can have a look at each of the line items that are on the K-1 and then see how that information ultimately gets transferred over to the 1040 and how it is going to be subject to tax. Now, on the left-hand side here, we can see information about the partnership. So we have the partnership's EIN, partnership name and address. Now, this partnership is basically an investment fund. So the fund invests in various financial products or other businesses. And so it's going to have allocations of a lot of portfolio income, so interest, dividends, capital gains, and things like that. Now, information about the partner, we can see Amy's social security number, name, and address, and then an indication as to whether the partner is a GP or an LP. So in this case, Amy is a limited partner or other LLC member. And that's important because that's an indication that she does not actively participate in this business. And that's important because when you have things like line 1, ordinary income or loss allocated, you need to consider the passive activity loss limits, right? And so we'll talk about that a little later. Now in the H1, we've got a domestic partner indicating that she's a U.S. person. So she's a U.S. citizen, lives and works in the U.S., a U.S. resident for federal tax purposes. If you have a partner that is not a U.S. person, you may see an indication that they are a foreign partner rather than a domestic one. Now, in box L, the capital account reconciliation. So K-1s now have to be reported using the tax basis method. The capital account analysis in prior years, you can use a reconciliation that was either U.S. GAAP, 704B, you can use another type of basis or tax basis. Now you have to be using tax basis in this item L reconciliation. So we can see here that she contributed $18,000 to the fund, so that's the money she put in to become an investor. And her allocation of all of these income and expense items, so the net income or loss allocated to her during the year is $506. And she received a distribution of $160 for the 2024 year, which leaves her with an ending tax basis capital account of $18,346. Now, if we start diving into some of these line items, so line 1, ordinary business income or loss, this is her allocation of the ordinary trader business income that's flowing through from the partnership. So line 1 income is generally going to be subject to just the regular ordinary federal income tax rates. If you were an active participant in this business, this income may be subject to self-employment taxes as well. So if you have a K-1 that has a line 1 entry, and let's say you also see a line 14 box A entry of $5, that indicates that your allocation of ordinary income is also subject to self-employment tax. Because Amy does not actively participate in this business, we don't see a corresponding entry for the same $5 because it's not going to be subject to self-employment taxes for her. So when we have the $5, where does that land on the return? Well, it lands in a couple places. So the first one is because this is a passive activity to Amy, she should be completing a Form 8582 for the passive activity loss limitations. Now, the original entry should be reported on page 2 and part 5. So we can see part 2 or page 2, part 5, we have a listing of the activity. So the new partnership LLC, and we can see here the current year net income or loss. We have net income of $5. That's coming through from the K-1. No net losses on the ordinary income line, and there's no prior year losses or other activity. Now, it's important to remember that the only items that really get entered here, the income or loss items, are that ordinary income or loss items. So on the K-1, we can see we've got a lot of other income being allocated, interest, dividends, capital gains, but none of that gets reported on the 8582 because those are portfolio items. Those get reported separately on the 1040. All right, so once we have this field completed, you can see here that she doesn't have any other investments in passive activities. So the $5 is ultimately just reported up here in the other passive activity section, line 2A for activities with net income. And there we see the $5 entry. And so this is what's going to be reported up on Schedule E. So Schedule E on the 1040 is where you report a couple of things. So page 1 of Schedule E is where you would report activities from rental activities, right? So rental real estate, or if you had income from royalties, it would get reported up there. Schedule E, page 2, part 2, is where you report that income or loss from partnerships and S-corps. So we can see here we've got our row A entry. There's the partnership LLC. We've indicated that it is a partnership. We've got the partnership EIN. Now, basis computations are required in some cases for S corporation earnings, but in this case, we don't need to include that. And then we have passive income or loss, passive income from K-1s of $5. Now, if Amy was an active participant in this business, you would likely not see the 8582. You would just have the entry entered on non-passive income and loss in the corresponding column. All right, so we've got passive income or loss. There's our $5 entry, and once we have that total amount compiled, we go up to Schedule 1, additional income and adjustments, and we see here on line 5 we have our income from partnerships for $5. All right, and again, that amount is going to be subject to the regular ordinary federal income tax rates for Amy, depending on whatever her marginal rate ends up being. It's not going to be subject to self-employment taxes for her. All right, so that's line 1. Now you can see there's a number of other items here not applicable to this return, but if you have rental real estate income being allocated, that would also go to the 8582 and then Schedule E. Guaranteed payments for services or capital. If Amy was actively participating in this business and the partnership agreement provided for a guaranteed payment, so that's basically a wage, a fixed payment per month or per quarter, those amounts would be reported on lines 4A or B. Now onto the portfolio income section of the K-1. So we have interest income of $37. Now with partnerships, it's important to always kind of remember that when you think of these income items being allocated to you, you have to consider, well, if there wasn't a partnership structure in place here and I was just holding these assets directly and earning the income, where would they be reported? And so when we think of interest and dividend income, we're thinking of Schedule B. So if we have a look at a return here and we go down to Schedule B, where we report interest and ordinary dividend income, we can see up here in Part 1, interest, we've listed the name of the partnership, and then we've entered the $37 in interest income that was coming through from box 5 of the K-1. So there's our $37 of interest, and that's being reported up on Schedule B. Now in Part 2, ordinary dividend income, we have a similar entry. So we've listed the partnership LLC, and the K-1 shows ordinary dividends of $454. So that's what's being reported up on Schedule B in Part 2. Now with dividends, you always have to consider the qualified dividend portion. So 454 is the total amount of dividends that's being allocated to Amy. And then 273 is the portion of line 6A that is qualified. All right, so it's not as if you add these two together to get the total allocation. 273 is the portion of 454, which is qualified, and then the difference between those two is the non-qualified portion. So we have $273 in dividend income, and that effectively gets reported in two places. So the first one, we have to report it up on page 1 on lines 3A. So line 3A, we can see the qualified dividend amount. There's our $273 figure. And then the ordinary dividends, there's our $454 coming through from Schedule B. Now, qualified dividends, it's important to separate that because qualified dividend income is subject to reduced tax rates versus non-qualified dividends. So we have the 273 entry here, and then Amy would also use this figure to calculate or to complete the qualified dividends and capital gains tax worksheet, where she can calculate the reduced rate on that dividend amount. All right. Now, moving on to lines 8 and 9, we have net short-term capital gains of $74, and we have net long-term capital gains of $14. So those two items are going to be reported on the 1040 on Schedule D. So if we have a look at Schedule D, capital gains and losses, we can see that in Part 1, Amy hasn't traded any other stocks or bonds or cryptocurrency in her own accounts. So that's why we're not seeing any entries for lines 1A through 3. But you might have entries there if you have your own brokerage account. And we see the same things for line 8A through 10. Where we do see the K-1 amounts are lines 5 and lines 12. So line 5, allocation of net short-term gain from partnerships, S-corps, estates, and trusts. There's our $74 figure. And then on line 12, the same net long-term gain allocation is $14. All right. So once Schedule D is completed, again, you're going to have to complete the qualified dividend capital gain worksheet to figure out the reduced tax rate that would apply to the $14. All right. Now, moving on to some of the other items. So really important here to highlight lines 9C and 10. So line 10, net 1231 gains. 1231 gains are gains or losses from the sale of assets used in a trade or business. All right, so the nice thing about 1231 is any kind of gains are subject to reduced rates, but if you have losses, it can be used to offset other ordinary income. 1250 recapture, this has to do with real estate. This is a fund that doesn't have real estate investments, or it might, but it just is not renting them out, or it certainly hasn't sold anything. So that's why we see blanks for 9C and 10. Section 179 deduction. So 179 deduction is taken at the business level, but it has to be separately stated because there's limitations that apply at the partner level. Right now, in this case, again, no 179 deduction is being claimed, so it doesn't apply to us in this scenario. Now, line 13, other deductions, we can see a couple items here. So line 13A for $4 is an allocation of charitable contributions. So what happened here is the fund made a contribution to a 501c3 public charity. And so when the partnership makes a charitable contribution, it allocates that charitable contribution amongst the partners. And the partners, if available, claim that on their return. So line 13A, $4. If we have a look at Amy's tax return here, the $4 for her is going to be a moot issue, can't be used. And that's because she's taking the standard deduction. So if we look at line 12, we can see Amy is claiming the $14,600 deduction. She is not itemizing deductions. So we've included this Schedule A just for sake of being able to trace this to make it easier. But we can see here Schedule A itemized deductions. The total amount of itemized deductions that Amy has amounts to $924. So obviously she's not going to use this. She's going to use the standard deduction instead. But we can see here on line 11, gifts of cash or check, there is the $4 from line 13A that's being allocated to her. So if you are someone that itemizes your deductions and you receive a K-1 that shows a charitable contribution allocation, you can claim that on your taxes. You report it on Schedule A just as if you wrote the check yourself. But again, in this case, because Amy is not itemizing, the $4, she can take it into account, sure, but it's not going to be used at all under her circumstances. So it really depends on a partner by partner a kind of fact pattern. All right, so now if we go back to 13, we can see that there's some additional items here on a statement. And this is quite common. If you have a lot of different line items or that apply to a certain field, they won't be able to fit everything within the same box, and so they'll add a statement and say, go reference the statement, and then you can get more details. So if we look at the statement here, so line 13, other deductions, we can see a couple of entries. So we've got a code 13H for investment interest expense, and we got 13 code double Z for investment management fees, legal and accounting fees. So if we look at the investment interest expense first, we can see that's also $4 of investment interest being allocated to her. So where does that get reported? Well, investment interest expense is also treated as an itemized deduction. So the investment interest expense would first get reported on a 4952 to calculate the investment interest expense deduction. Now, the amount of investment interest expense is going to be limited to your investment income. So she does have availability here to use the $4. However, same issue applies with the charitable. If we look at Schedule A for interest paid, you can see on line 9 here, we've added the investment interest expense with the 4952 for $4. But again, the total amount of itemized deductions for her doesn't amount to enough to make sense to claim itemized deductions. She's going to use the standard instead. So the so the interest expense being allocated to her again is just not going to be able to be used. Now, with the other expenses here, these can be a little tricky. You have to really think about what these deductions are and then the context of what kind of activity this partnership is engaged in. So this is a partnership that's an investment partnership. So it's not a trader fund. It's not an actively managed fund. And the reason why that's important is when you have things like investment management fees or other expenses that apply to this fund, those are previously treated as miscellaneous itemized deductions. So miscellaneous itemized deductions would be reported somewhere down here on line 16. And these are deductions that can be claimed to the extent they exceed 2% of your AGI, your adjusted gross income. However, with the Tax Cuts and Jobs Act that was passed back in 2017, they eliminated miscellaneous itemized deductions altogether, right? Now, that is supposed to expire at the end of 2025. We don't know if they're going to renew it. But because of that limitation, expenses like these in this context are allocated to partners because the money was spent, but they're not going to be tax deductible. So Amy's going to use these in calculating her basis. She's getting them allocated to her. But for individuals, they're not allowed to deduct these type of expenses anymore. So these amounts aren't reported anywhere on her Form 1040. They're expenses that are just kind of lost. All right. Now, if we go back to page 1 of the K-1, let's scroll on up here. So line 16 has to do with foreign activity. So if you have any foreign source income or other operations, or if you have foreign taxes that you want to claim as a credit, that information is going to be included on the Schedule K3. And that the partnership will check this box and attach a K3 to the K1 package. So we will have some foreign activity included with this return. So if we scroll down, let's have a look at that Schedule K3. Okay, so this is the Schedule K3, Partner Share of Income Deductions or Credits International, right? So this is, these are, again, income and expense tax items related to foreign activities. So if we scroll on down here for the foreign tax credit limitation. So the way this works is the partnership will basically provide more detail. They'll break out all the activity of the company and they'll let you know what is the sourcing of all the income that's being passed through to you, right? Now, some partnerships provide more detail than others. This form is relatively new, so I think people are honestly still getting used to it. But in this case, for example, if we look at Section 1, line 7, we can see the ordinary dividend income here. What they've done is they've let us know that, okay, of all the ordinary dividend income that's being allocated to you, There's $175 is U.S. source. So we have the U.S. source, 175, and it's coded to the U.S. of A. And then the foreign source passive category income, we have $2 that's being allocated from Canada. So in other words, the partnership invested in some Canadian stock and it received a dividend distribution. So that's dividends from a Canadian company, Canada source income. So we have 175 of US source, $2 of Canada source. And then when we look at the qualified dividend section, we can see qualified dividend income, $271 of US source income, and then $7 of Canadian source income. All right. Now, the K-1 will also let you know the amount of foreign taxes that were withheld or paid on your behalf as well. So if we look at line 21, you can see here foreign taxes paid or accrued were $2. So we had $9 of income, ordinary dividend income being allocated to us, and there was $2 of taxes withheld on that allocation. So Amy needs to, if she wants to be able to take credit for these foreign taxes allocated, she needs to accurately report that on her tax return. So if we have a look at the 1040, the foreign tax credit section, so this form is used to report all of that foreign source income that you might have received and then claim any expenses or foreign taxes that are attributed to that allocation of foreign income. So in this case, very small dollar amounts, right? Kind of nominal. Frankly, I see a lot of people just even pass on this. If the amount of credit is really, really low, they just don't even bother, which is fine. But you can imagine that high income earners that have large allocations of foreign source income might have a lot of foreign taxes paid or withheld on that income. So they really want to make sure they get the credits to not make sure they're double paying on the taxes. So in this one, we've indicated it's allocated from Canada and it's dividend income. The total amount of income was $9 in dividend income. And then if we look at the foreign taxes paid or accrued section, we've entered in US dollars, $2 were withheld on those dividend earnings. Now, the 1116 can be quite complicated. If you have foreign qualified dividend income, you have to make certain adjustments. However, there are de minimis rules where if your AGI is below a certain range and the total amount of foreign source income is, I think it's less than $20,000 was the current number, then you don't have to make any of those adjustments. If you have foreign qualified dividend income, you can just lump it all together and then don't have to make any adjustments. Now, the 1116 for Amy in this case, when she figures the whole credit, the total amount of credit she's going to be able to use is $1. So she was allocated $2, and she's going to claim a $1 foreign tax credit, and then the remaining $1 just gets carried forward. All right. Okay, so that's the foreign tax piece. Line 18A for tax exempt income and other non-deductible expenses. So again, this is another C statement, so that it wants us to look at the supplemental information. So we look down at line 18 here and we see code A, federal tax exempt interest, and it's an allocation of $17. All right. Now, where does that get reported on the return? Well, it can be a couple places. So the first place you're going to report it is on page 1. So page 1, line 2A, we have tax exempt interest income of $17. Now this figure isn't included anywhere in this total because it's exempt from federal income tax. All right, so you have to report it because it is gross income, but it's not going to be subject to federal income taxes. It's important to remember, however, that federal tax exempt interest, although it is exempt from federal taxes, in some cases it might be subject to state income taxes. All right, because this is municipal bond interest, basically. So if you have municipal bond investments from Florida, let's say, but you live in New York, you're not going to pay federal income taxes on that Florida municipal bond income, but New York might tax it. All right, so you got to be careful about what kind of income it is and where you're a resident, because it might be subject to tax in some manner. The other thing to consider is if it's municipal bond interest, but it's private activity bond interest, still exempt from federal income taxes, but you require an alternative minimum tax adjustment, AMT adjustment. So that's another thing to keep in mind. No indication on this K-1 whether this is private activity bond interest. So not much we can do there. But nevertheless, that's how it gets reported. So it gets reported on page 1, not subject to federal income taxes generally. Might be subject to state income taxes, and then you might have an AMT adjustment if it is private activity bond interest. All right. Now, line 18 done. Move on to line 19. So line 19, code A, represents the amount of distributions. So this is cash. This is cash or other property that is distributed from the partnership to you. So in this case, it was just a cash distribution of $160. And so we did see the same amount reported down there in the capital account reconciliation. So the distributions here, there's nowhere on the return necessarily where this is reported, right? Because it's a return of capital, so that item in and of itself is not taxable. Now there's rules where if you have distributions in excess of basis, you might have to record a capital gain on the distribution, but in this case, Amy has sufficient basis here. She's got well over $18,000. So there's no distribution in excess of basis, and so no capital gain recognition. All right. And then line 20, other information. So this is these items, if you're preparing like your return with software, let's say, as you enter these items, you find that most of it is just informational. It's not going to actually show up on the return. But items that would be included are things like information on qualified business income deductions and the like. And so if we look at code, okay, so this one has a box 20, code ZZ. So code ZZ is telling us that there is U.S. Treasury interest that's included in line 5. All right, so $3. So what are they saying there? Well, if you look at line 5, interest income was $37. All right, now U.S. Treasury interest within that amount is $3. So the rest of it might be just bank interest income, and they're letting us know that, okay, of the 37, the $3 is going to be U.S. Treasury interest, and that's important because state tax purposes, right? So U.S. Treasury interest is not going to be subject to state income taxes generally, right? And so that's important because if you were doing a state income tax return, you would put the $37 down, but then you would have to have an adjustment to basically reverse out $3 that's U.S. Treasury interest. So not taxable for state purposes. All right. Okay, so let's see what else is in here that might be worth commenting on. The basis worksheet. Okay, so we have a basis worksheet here, and this was provided by the partnership within the K-1 package, but we'll also have a look at the partnership basis in the 1040 return as well. So we can see here partnership basis worksheet prepared as part of the partnership records, and they note here that your outside basis must be determined at the partner level, right? So partnership can do a worksheet like this, which is very helpful, but each partner needs to calculate their own basis based on what actually gets allocated to them and what's actually recorded on the tax return. So we can see here that the ending basis, 18,346, that reconciles with the Schedule K-1, right? 18,346 reconciles with the box L figure that we saw up here. So there's our 18,346 tax basis capital account. So that all jives kind of well. Let's go back to the return and see if there's any items we need to look at. I don't think so. Okay, so we did the $5. Schedule 3, additional credits and payments. So there's the foreign tax credit. So we did do an 1116. Although the 1116 wasn't required, it's not uncommon to just do it. Again, there's another de minimis exception where if the amount of foreign tax credit you're going to claim is below a certain dollar threshold, you don't have to do an 1116. You could just put the amount of foreign tax credit in there and then be done with it. In Amy's case, she did include the 1116. And so that $1 credit is being reported up here on line 20. So all in all, we look at Amy's return. She's got her wages. We've got the various types of portfolio income, capital gain allocation, the $5 coming through from that ordinary income or loss, line 1 of the K-1. Total income, she's claiming the standard deduction. Remember, she's not getting any benefit for the allocation of investment interest expense, no benefit from the charitable contribution. Okay, and then those portfolio expenses aren't being reported anywhere either. So on taxable income of $57,984, she owes $77.85 in tax, gets a $1 credit, dropping it down to $77.84, and then we have her withholding from her W-2 from the employer, and so that's the bottom line refund amount for her for this year. Okay. All right, I think that covers it. I hope that was helpful. Just kind of high level, step by step, how some of these items get recorded. So I appreciate you watching and sticking through it with me here to the very end. And as always, I do appreciate you watching and look forward to seeing you on the next video. Thank you.